Hello and good afternoon, friends. Welcome once again to CEC-UGC live lecture. Dear friends, as you know that since yesterday we have been talking a lot on the Indian economy and overview. That is, we could say that today this lecture of ours is in continuation with the previous lecture on Indian economy and overview. Yesterday we discussed about the general features of the Indian economy, as well as we covered major areas such as growth indicators, the causes of Indian economy, as well as we discussed about inflation. So continuing our lecture forward, today we are going to talk about trends in employment elasticity, aggregate demand, consumption, investment, slowdown in investment, public finance. These are the major areas which today we are going to cover for you. That is, these are the areas we are going to discuss about. And for this, we have with us in our studios Dr. Bharat Singh. He is an associate professor in Department of Economics, Satyavati College, University of Delhi. So first of all, I would like to welcome our guest, Dr. Bharat Singh. Dr. Singh, welcome to the EDSEC lecture. And the way through the previous lecture we understood about the Indian economy, I hope that from today's lecture also the students would be benefited after covering all the major areas which we are going to cover. So over to you, sir.
Thank you, ma'am. Thank you. Friends, in our studies lecture, we had discussed some important features of the Indian economy, because as I told yesterday that unless and until we know and understand the basic characteristics, basic features of an economy, we would not be doing justice in understanding the different aspects of the Indian economy, the problems being faced by Indian economy, or what important policy measures should be formulated and implemented for solving those problems. In continuation to my yesterday's lecture, after discussing the important features of Indian economy, we deliberated upon some important macroeconomic variables related to the growth rate, the employment, the inflation, and so on and so forth. Today, we will be discussing we will be rather focusing on the problem of employment in Indian economy. As we have discussed already that the Indian economy is going through a phase of slowdown since last 2 consecutive years, and we have been able to achieve a sub 5% growth rate during the financial year 2012-13 and 2013 and 14. This slowdown in employment growth in recent years has been a matter of serious concern for all of us, including the government, the policy makers, and the planners. The working age population of India is growing in size. The labor force is shifting away from agriculture, and with the higher education working, the higher education workers are also seeking better quality non-agricultural jobs. What I mean to say by focusing on these points, that these are some of the important dimensions of the changes in the employment sector. However, the trends between 2004 and 5 and 2011 and 12 indicate the employment generation in country has been inadequate to meet this challenge. So far as sectoral generation of employment in Indian economy is concerned, construction has virtually become the only source of incremental employment in rural India. In the urban areas, men have been able to obtain a disproportionate share of the high productivity employment job. These are some of the figures related to the composition of comparison of employed persons in and employment rate based on UPSS. The data as given in this table show that the number of employed peoples has increased in absolute terms. We see that in during the year 1990. We see that during the year 1999-2000, the number of employed people was 396.76 million, which increased to 472.9 million during the year 2011 and 12. This figure is given by the NSSO 68th round of survey 2011 and 12. The unemployment rate has also increased from 2.2 to 2.3, and only during the 2009 and 10 the unemployment rate has decreased, but again it has risen to 2.2% of the during the year 2011 and 12. A comparison of the above data shows that there has been a consistent increase in absolute employment across various sectors, and we have already stated the figure that it has increased from 96.8 million in 1999-2000 to 460 million in 2009-10 to 472.9 million in 2011 and 12. Although the absolute employment has increased, but the unemployment rate, which was rising till 2004-5, fell in 2009 and 10, but has again risen slightly in 2011 and 12 to become 2.2%. This decrease in the employment rate or increase in unemployment rate associated with increasing rate of economic growth indicates towards the occurrence of a jobless growth. What do we mean by jobless growth? Jobless growth is a situation in which growth in GDP fails to generate commensurate employment opportunities for the job seekers. Such situation may persist as a result of capital intensive choice of technique. So, choice of techniques has a lot to do with the fact whether the employment is generated in the process of economic growth or not. There may be some other factors also in generating less employment opportunities, even if the rate of economic growth is high. These may relate to some structural factors existing in the labor market. Jobless growth situation coincides with low employment elasticity of a particular sector or for the whole of the economy. Sometimes we may witness a trade off between the objective of growth acceleration and job creation. What does this trade off mean? See, if we want to increase or accelerate the rate of economic growth, we may be tempted to use the modern technology, and modern technology can be used largely when large quantity of capital or increased quantity of capital is employed. So, this modernization of technique of production may be a proxy for employment of more quantity of capital. If we adopt the capital intensive technique of production, then it will have it may have a negative bearing on the job creation also. What is employment elasticity? When we speak about the employment elasticity in creation of job, employment elasticity is a measure of the percentage change in employment associated with a 1 percentage point change in economic growth. It indicates the ability of an economy to generate employment opportunities for its labor force as percent of the growth or development process. We have some figure related to sectoral employment elasticity as per the 12th 5-year plan, and this figure shows that the agriculture sector has the lowest employment elasticity, showing just 0.04, and the construction sector has the highest employment elasticity 1.13%. The world average of the employment elasticity was 0.3 during the year 2000 and 2008. In India, during the period 1993-94 to 2011 and 12, the average employment growth has been 1.1% on CAGR basis, while GDP has increased about 6% on CAGR basis, and employment elasticity has been hovering around 0.1% on CAGR basis. CAGR is compound annual growth rate. Before the period of economic reforms, particularly the period from 1972 to 1983, the figure of employment elasticity was well above 0.5% on CAGR basis, which means that after the economic reforms, the employment creating capacity of our growth process has declined considerably. According to some other estimates, elasticity vary considerably across sectors also. While agriculture has witnessed negative elasticity, services including construction have generally been employment intensive, and manufacturing employment elasticity has hovered around 0.29 to 0.33, and within manufacturing also the organized manufacturing sector, based on various estimates, seems to be showing higher employment elasticity in the range of 0.42 to 0.57 in the decades of 2000. So far as the further analysis of elasticity is concerned, there is huge productivity and wage differentials between the organized and unorganized manufacturing sector. The organized manufacturing sector is favorably placed so far as the creation of a good quality job or the decent job is concerned. Therefore, if our economy wants to create more jobs which are of decent quality, which are of good quality, they should put more emphasis on creating more jobs in the organized manufacturing sector and not in the informal sector. The benefit of creating jobs in the organized manufacturing sector is that it has further multiplier effect, and creation of job in manufacturing sector results into creation of employment and output in other sectors also. The employment elasticity or rate of labor absorption in the process of growth depends to a large extent on several factors. These may be the relative cost of capital vis-a-vis labor. It means, in order to produce 1 unit of output, what is the cost if you employ capital, and what is the cost if you employ labor in order to produce that unit of the output. Then what is the nature of investment demand in the economy, what kind of the goods and services the producers or manufacturer wants to produce. The next important factor may be increased capital to labor ratio in the organized sector for a labor abundant country. The increased capital to labor ratio in the organized sector for a labor abundant country like India is really a cause of concern so far as the generation of employment is concerned. Now, what are the challenges and opportunities in the area of employment generation for the policy makers in India? In India, the size of working age group is very large, which may prove to be an asset for our economy if we are able to manage and plan this huge size of the working population, and a terminology is used for this segment of working population, that is demographic dividend. If we are able to create decent and gainful employment opportunities for this segment of the population, we will be able to reap the demographic dividend of our country. The growth strategy should focus on industries where employment elasticity is higher. The next important consideration that the government should keep in mind the overall structural changes taking place in Indian labor market while creating new jobs or while formulating policies to create new jobs. What is this dynamics going on in the labor market? We can find that a large size of the workforce is moving away from agriculture to industry and services sector, and there has also been reduction in the women labor force as a large segment of women population is preferring education over work. So, women are preferring to get more and more education, and this has resulted into the exodus of women workforce from the labor market. In such a situation, the non-farm sector, that is industrial sector and the services sector, has to gear up adequately to shoulder the burden of the surplus labor from agriculture sector. Among the non-farm sector, India's growth and employment story has been dominated by the services sector. The manufacturing sector, particularly the organized manufacturing, has to play a more important role in creating good quality jobs. This table exhibits a share of major sectors in total employment in percentage terms. We can see that the share of agriculture and allied activities in total employment has been declining since the year 1999, and it has declined from 59.9 to 48.9 during the year 2011 and 12. The share of industry, on the contrary, has increased, and the share of services has also increased. The decline in the share of agriculture and allied sectors in total employment is an important indicator of development, because the development experiences of many developed countries have shown us that in the process of development, if a country develops, the composition of output in GDP, the composition of employment and composition of foreign trade goes on changing. So, if a country is moving fast on the path of development, the GDP changes, the composition of GDP changes in favor of industrial sector, particularly the manufacturing sector and the services sector, and similarly the employment generation takes place largely in the industrial sector and the services sector. So, in the process of growth and development, the working population moves away from the farm sector to the non-farm sector. This is a fact which has been witnessed in the development experiences of many developed countries of the world. When we speak of the employment of generation of employment opportunities in an economy, it is also important to see some inter-sectoral linkages in the economy. Inter-industry linkages can be seen by looking at the input flow matrix of the economy. This inter-industry input flow matrix is one way to study inter-sectoral linkages, both backward and forward. The study of such matrix gives us an idea as to what extent the growth of one sector depends upon the other, and how in turn one sector promotes the growth of the other sector. This table shows the input output matrix of the Indian economy, and the data is based on 2007 and 8 in percentage terms. The table shows that out of total input required by the agriculture and allied sector, 55.3% is contributed by the sector itself. Industry and services accounted for 21.4 and 3.3% respectively, and more than 2/3 of the total inputs required by the industry came from industry itself, while nearly 1/4 were from the services sector. In service sector, more than half of the input was contributed by industrial and agricultural sector. The input-output matrix has shown in above table reveals the importance of industry and industrial sector in sustaining the growth of services sector, because more than 50% of the input for the services sector comes from the industrial sector. So far as the aggregate economy is concerned, the agriculture and allied activities contribute about 11.8% of the total inputs required by the economy, whole economy. The contribution of industry is about 59.6% and services contribute about 28.6%. This pattern of input distribution among the different sectors reflects that if Indian economy is to move on a high growth trajectory on sustained basis, the sustained recovery of industrial sector is an essential condition. After discussing different aspects of the employment generation, we will now focus our attention on the aggregate demand, because this aggregate demand is also a very important factor which drives the process of development of any economy on higher trajectory. In line with the theory of Keynes related to income, output and employment, it may be stated that the higher the aggregate demand, the higher will be the income, output and employment, other things remaining the same. What do we mean by aggregate demand? Aggregate demand in an economy equals the sum total of final consumption expenditure, the investment expenditure and the net exports. Aggregate demand measured in terms of GDP at constant price 2004-05 registered a growth of 5% in 2013-14 as against 4.7% a year ago. These data we have already discussed in our yesterday's lecture. In real terms, both the consumption expenditure and investment registered a decline during the year 2012-13 and year 2013 and 14. Whatever increase in aggregate demand was visible during the period, it was due to increase in net exports. Consumption is an important component of the aggregate demand. The share of final consumption expenditure in GDP has been declining consistently since 1950s. During 1980s, the final consumption expenditure share was 85.8%. In 2000, it declined to 71.6%, and in 2010 to 14, its share declined to 68.4%. A decline in share of private final consumption expenditure is the main contributory factor in reducing the final consumption expenditure from 85.8% during 1980s to 68.4% during the year 2010 and 14. This decline in private final consumption expenditure and the total final consumption expenditure is not surprising at all, because we know that as the income of a person or income of an economy increases, the marginal propensity to consume declines progressively and marginal propensity to save increases commensurately. What does it mean? That as the income increases, we tend to reduce our consumption proportionately and the proportion of saving increases gradually. So, therefore, the consumption component of the aggregate demand has increases and its place has been taken by the increase in investment. In order to sustain the high level of economic growth, rate of investment must increase, which will mainly be financed through increased domestic saving. So, if consumption is declines and on its place the investment increases, then it may be said to be a good sign for the economy, provided the decline in consumption expenditure is compensated or more than compensated by increase in demand for some other commodities. The government consumption expenditure as a proportion of GDP has maintained its consistency, because in 1980 the government consumption expenditure was about 11.3%, while in 1990s also it was about 11.6%, and during the year 2010 and 11 it again stood at 11.6%. So, there is consistency in the government final consumption expenditure. Further, the pattern of final consumption expenditure has largely changed in favor of the banking, insurance, legal, business and miscellaneous services, and it has moved away from the non-durable goods, especially the food items. Investment is the second important component of the aggregate demand. It consists of fixed capital formation, acquisition of valuables and change in stocks and inventories. Investment as a ratio of GDP in India was 24.5% during the year 1990-91 to 2003-04, which increased to 30%, and this year 2003-04 is important because it has exhibited a breakaway. It has exhibited you can say a departure for the first time, touching 30% rate of investment. Between 2004 and 5 and 2012 and 13, the rate of investment averaged about 35.4%, and it touched a peak of 38.1% during the year 2007 and 8. The year 2007 and 8 is the year of you can say a very good year in terms of rate of economic growth. This table shows the pattern of investment by institutions. We see that the investment by public sector undertakings has more or less remained constant. In the year 1991 to 1999-2000, it was 8.8%, which has marginally declined in the year 2012 and 13. But as compared with the year 2001 to 2003-04, it has increased. So far as private corporate sector is concerned, its contribution has also marginally increased when we compare it with the year 1991-2000 and 2001 to 2003-04, but taking into consideration the periods from 2004-5 to 2007-8 and 2008-9 to 2012 and 13, its contribution has declined. What is encouraging is the contribution of household investment, which has increased which has continuously increased, you can say, since the year 1990-91 to 1999-2000. The household investment has increased from about 8% to 14.8%. The total investment picture is also encouraging, because this total expenditure figure has increased from 24.3% to 34.8%, which is a good sign for the Indian economy. But taking into consideration the two preceding financial year of slowdown, the investment has also been affected unfavorably. We should take into consideration, we should focus on what are the important factors responsible for investment slowdown in India. The first important factor is the nominal rate of the rate of interest and the nominal rate of interest affects investment activities only during the short period of time. So, since the rate of interest has been rising in India, it has affected negatively the sentiment of investment. This nominal rate of investment is more pronounced for investment decisions at the firm level and not at the macro level. According to one study by the RBI, lower real interest rate may stimulate investment and growth provided it is not achieved via higher inflation. It means the lower rate of investment should not be accompanied by the higher inflation rate. Sometimes too much leveraging may also affect investment process negatively due to decline in cash flow of the corporates. The reasons for decline in cash flow of the corporates may be sluggish demand condition, the weak pricing power of the firm or the industry, high input cost and delays in collection of receivables after the delivery of the orders. Post 2007-8 slowdown in investment may be explained in terms of domestic policy uncertainty, global economic uncertainty, subdued business environment, bleak business confidence and high and volatile inflation, partly caused by high fiscal deficit. The domestic policy uncertainty mainly refers to difficulties in land acquisition, delayed environmental clearances, infrastructure bottlenecks, problems in coal linkage and ban on mining in selected areas. The problems as mentioned above may be solved in and investment boosted only by creating an investment friendly environment in the economy. The investment friendly environment may be created by formulating and implemented such policies which have a long term vision embedded with clarity and transparency. In order to incentivize the investment, the policies should largely focus on structural reforms in the economy and removing supply side bottlenecks including the GST. Now, we come to the third important component of the aggregate demand, that is net exports. Net exports in national accounts are defined as the difference between exports and imports of goods and non-factor services. The share of exports in GDP increased from 24.0% in 2012-13 to 24.8% in 2013 and 14. The share of imports in GDP declined from 30.7% to 28.4% during the same period, while the net exports figure improved by 3.1 percentage point of GDP for the period under reference. What are the important factors for the improvement in the net exports in India despite witnessing slowdown for a substantial period of time? The first important factor is the partial recovery of global economy from its downturn, especially the US economy. This partial recovery of global economy and including the US economy has helped India strengthen and improve its export performance. The demand for Indian goods increased abroad and it has resulted into the earning of more exports, promoting more exports to foreign countries. Import was curbed mainly on account of measures taken by the government and the RBI. These the measures related to curbing imports was taken mainly to contain the CAD, that is current account deficit, and de-incentivize import of non-essential items. Other important factors of improvement in the net exports is the domestic economic slowdown. Due to slowdown in the domestic economy, the demand for imports also was restricted, which has an important bearing on improving the net exports. The exports increased and import value of import declined. So, these are some of the important factors that have helped our net exports, an important component of aggregate demand, to improve a lot. Now, we come to the next important macroeconomic variable of Indian economy, that is public finance. If we speak of public finance, it is important to mention the Fiscal Responsibility and Budget Management Act, which was introduced and enacted during the year 2003. This act was enacted in 2003. What were the objectives of enacting this FRBM Act? The first important objective was to institutionalize the financial discipline in different departments, different sectors of the economy, and the economy as a whole also. Second important objective was to reduce India's fiscal deficit to a manageable level of 3% of GDP by March 2008, because before 2008 the fiscal deficit was very high for Indian economy. The third important objective was to improve macroeconomic management and the overall management of the public funds by moving towards a balanced budget. As a result of adoption of FRBM Act 2003, the fiscal deficit of the center was brought down to 2.5% of GDP, which was really an outstanding achievement, because the target for the fiscal deficit was 3%, but we have been able to achieve a 2.5% of GDP as fiscal deficit. In the wake of global financial crisis in 2008-9, the fiscal deficit was deliberately increased to boost the aggregate demand. If we speak of using the fiscal deficit as a tool of boosting the aggregate demand, it means we are speaking of about increasing the public expenditure. Whatever is the situation on the revenue side, if we increase the public expenditure, the money spent by the government goes into the hands of the people, and thereby it increases the purchasing power of the people in general. If the purchasing power of the people in general increases, they increase the demand for different goods and services in the economy. The investors and the manufacturers, the producers, they get the incentive to invest more, they get the incentive to produce more, and this situation acting through the backward and forward linkage and as a chain reaction increases and incentivizes the demand for other goods and services in other sectors, and we can say in Keynesian economics terms that the economy may be brought up from the situation of slump to the situation of recovery, and thereby the income, output and employment of the economy is expected to increase. So, keeping in mind this theory and this objective, the fiscal deficit was planned to be increased deliberately after 2008 and 9. It is a different story that India was able to come out swiftly out of the global crisis of 2008 and 9. After the Indian economy recovered on the path of development after 2008 and 9, the government of India adopted a policy of gradual consolidation of fiscal deficit, and this gradual the policy of gradual consolidation of fiscal deficit was adopted in the year 2010 and 11. The targeted fiscal deficit figure for the year 2013 and 14 was kept at 4.8% of the GDP, but the actual figure was 4.5%. So, here also we have been able to keep our fiscal deficit within the limit. The exercise of fiscal consolidation was targeted for the year 2016-17 also, and going down the line since the year 2010-11, every year it was it has been envisaged in the policy that the fiscal deficit should gradually be increased by 0.6% per annum, 0.6% of the GDP per annum, so as to reach a figure of 3% of GDP by the year 2016 and 17. If we speak of the fiscal deficit management, what are the areas of concern in the Indian economy that fiscal deficit is kept under manageable limit, as well as the public expenditure, particularly the expenditure on public welfare, is also not hampered. The public expenditure on social sector is also not hampered grievously. Some important areas of concern may be that there has been a shortfall in tax revenue in the last couple of years. There has been a shortfall in disinvestment receipts. The government of India adopted a policy of disinvestment by for generating more revenues for the government exchequer, but the speed or the pace of disinvestment has not been as fast as was desirable. So, this is a problem for the government as far as the generation of revenue is concerned. Another important area of concern is the budgeted subsidies, the higher rate of budgeted subsidies. We know that the government of India grants subsidies to different items, important among them being the food subsidy, the fertilizer subsidy, the subsidy on LPG, and so on and so forth. Earlier, the subsidy was also granted for the diesel and petroleum prices, but thanks to the new policy initiative that the subsidy on diesel has completely been wiped out, and it has been the prices of the diesel has been handed over to the market forces. Another important, so far as subsidies is concerned, whatever subsidies the government is granting to different on the different heads, this amount of subsidy, this direction of subsidy must also be rationalized to a great extent in order to contain the non-productive expenditure of the government of India. Another important area of concern is the high level of interest and pension payment. The high level of interest payment is mainly on the borrowings of the government and the public debt. This public debt is generated as a process of generating the fiscal deficit for the economy. So, therefore, if we want to contain the high interest payment on the public debt, we must also keep the level of fiscal deficit under the manageable limit. The how can the fiscal consolidation be achieved? The fiscal consolidation can mainly be achieved through reduction in public expenditure, but a blanket reduction in public expenditure may prove to be counterproductive in the long run. During the short period of time, it may happen that government expenditure is reduced and the fiscal deficit is brought under control, but we have to exercise a caution as to which where the government expenditure needs to be curtailed and where the government expenditure needs to be maintained. To achieve the fiscal consolidation in the long run, there are certain suggestions that we must take into consideration. The first is the tax to GDP ratio must increase further. See, in the year during the year financial year 2013 and 14, tax to GDP ratio was 4.7%, and this to correct it, during the year 2013 and 14, the tax to GDP ratio was 10.1%, while the GDP was 4.7%. And this tax to GDP ratio has been targeted for the financial year 2014 and 15 as 10.6%, keeping into mind that we are expected to achieve a growth rate of 5.4 to 5.9%. Second important consideration for financial fiscal management is your burden of subsidies must be rationalized. This subsidies nowadays is 2.26% of GDP for the financial year 2013 and 14. As we have already talked, that higher fiscal deficit results into higher public debt and interest payment. During the year 2013 and 14, government liability to GDP ratio was 49.4%. Out of this total public debt, internal debt constitutes 95.5%, while rest is accounted for by the external debt. It means whatever borrowings is done by Government of India, the majority, the lion's share, 95.5% is borrowed domestically, and for this the Government of India has to pay interest, which is an important component of the fiscal deficit. So, friends, we have just now discussed different aspects of the Indian economy, and what policy measures should be taken by the Government of India in order to accelerate the employment potential of the country in different sectors. Then how the existence of inter-sectoral linkages can be used to the advantage of the existence of backward and forward linkages of different sectors of the economy, and what important considerations should be taken by the government in order to rationalize the fiscal deficit of our country.
Thank you, sir. Thank you so very much. I hope that this lecture would have winded up, or you have something else also to discuss with the students.
Yeah, in the series we will discuss it in the
definitely in the future lectures we would be conducting or talking more on the Indian economy, and we would be able to get more insight as the way we got today. So now the question here is, sometimes we used to say that the economy of the country is on the verge, it is at the highest point. At that point, can we say that yes, we are meeting the employment needs of the country?
Yeah, we can say, but the employment generation in our country has not been commensurate with the rate of growth of our economy, and during the past couple of years the employment potential has suffered because of the slackness in the growth rate of our economy, and in order to generate more employment, several steps are needed by the government. There are structural rigidities in the labor market, there is slackness in the business confidence. The corporates, both domestic and global, are hesitant to invest more and more in Indian economy in the absence of clarity on the front of regulatory provisions, etc.
Sir, as in previous lecture you explained about the inflation, sometimes we also heard of the term deflation. So, what is the major difference between these two terms if we talk about it independently?
Inflation is the increase in the general increase in the prices of different goods and services, average, and deflation is contrary to it when we witness the decline in the prices of different goods and services. It is a situation of deflation.
So, why basically this deflation occurs, as you said, when we are talking about the decrease in the prices? What could be the reasons behind this deflation?
When the aggregate supply in an economy supersedes the aggregate demand, it means demand for different goods and services are declining, or it has become stagnant. So, if the demand for different goods and services are deficient, in the producers or the manufacturers have extra stock of goods in their godowns. So, in order unless and until this stock is cleared from their godowns, they reduce their the level of production, and if the level of production decreases, it creates a situation of employment. Purchasing power decreases, demand decreases, so prices decrease. This is the demand side of the deflation problem. On supply side, sometimes it may happen that there is excessive production of some commodity. So, supply increased too much in relation to demand, resulting into fall in the prices of the goods. This kind of the situation we witness mostly in case of the agricultural produce.
Sir, sometimes we also say that demand and supply, when demand and supply goes hand in hand, then does it affect the per capita income of the country?
No, it has nothing specific to do with the demand and supply equality. Per capita income is just the average income per head of population in an economy, and simply we calculate it arithmetically that per capita income is total income divided by number of people in the economy. So, if the national income of an economy increases and the rate of increase in population proportionality is less than the increase in national income, the per capita income will automatically increase.
As you have already explained about the consumption, that is employment elasticity, but we would like to tell you, ask you that if we talk about the employment elasticity, what basically it is?
Employment elasticity basically refers to the percentage change in the rate of employment with 1% change in the rate of GDP. So, it basically states in layman terms that if GDP is increasing, to what extent it is creating simultaneously the employment opportunities in the economy. It may happen that GDP is increasing, but it is so highly capital intensive that it is unable to create extra jobs for the job seekers in the economy. In that case, we can say that employment elasticity in the economy is very low, and GDP is increasing, but the jobs are not increasing. It may vary from economy to economy, it may vary from sector to sector also. As we have seen in our discussion that agriculture sector has the lowest employment elasticity, while the construction and some service activities have a very high employment elasticity. So, if the output in those sectors increases, the employment elasticity also increases commensurately.
And when we are talking about the demand, and especially the aggregate demand, could we say that the demand in total?
Yeah, aggregate means total demand consisting of consumption demand, the investment demand, and net exports. These three are important components of aggregate demand, the total demand.
And when we talk about the slowdown in investment, what really does it mean? We are saying that there is a slowdown in investment.
Slowdown in investment basically means the investors. There are three segments of investors. One is the corporates, the other is the government, and the next one is the household. These three segments all together or separately are hesitant to undertake the exercise of investment because they are not expecting adequate return on their investment because of there may be several reasons, the general slackness in the economy, the business prospects are very bleak, or you can say that if you want to invest in some sector, the policy or the regulatory provisions in those sectors are not clear. So, therefore, if the investors are hesitant to invest in an economy, in a sector, there is its result is the general slowdown or decline in the level of investment.
So, as we had an overview of Indian economy, sir, what else are we going to study in the future lectures about Indian economy as a whole?
We will be discussing the outlook for 2015 and 16, 2014, 15 and 2015 and 16 in our next lecture.
I hope so that all the students who might have watched this lecture, our live lecture, would be benefited from this particular lecture, and it is my request to you that if you have missed some points live watching us, you could access YouTube, and with the help of YouTube you can access this lecture also, as well as multiple lectures we upload for you daily, so that all the difficulties you face while going through your course materials or while attending the classes, I hope that these lectures would be beneficial for you. With this note, we take your leave, sir. Thank you so very much for being a part of the EduSec lecture. Thank you.